Okay, Patrick, I have 4 sticky notes in front of me. I actually have 5 sticky notes in front of me, but the big conversation that I want to really start with and talk about is the rate hike. Um, I think, did you predict a rate hike? I forget, where are we at with the rate hike? I predicted, because I'm contrarian, I predicted they would lower rates, which means you probably predicted they would raise rates. So definitely I was 100% wrong again, because I'm just fooling around. But they ended up hiking rates again, and sending the good old markets in a tailspin. Maybe, maybe not.
Well, it's interesting that everybody had kind of forecast a rate hike. They kept saying, well, it's been built in and they know that there's going to be a rate hike. Yet they have a rate hike and everybody's, shocked and pissed off about it. So anyways, at the end of the day, it was expected and sadly they came through with it. So that's kind of where the rate hike conversation can start.
I guess the question and what, announcing that there's been a rate hike isn't exactly breaking news. Everybody knows that by now. But I think the breaking news is, what should investors do about it? Because as investors, as people who've been investing for a really, really long time, the Real Estate Investment Network's been doing this now for 30 years. You've been at this game for 39 years. I've been at it for 20 years. The point is that it's in these kind of moments of chaos. And even though this chaos gets kind of subdued as time goes on, the chaos that was literally a year ago and into the beginning part of this year, that chaos is kind of subdued. But let me tell you that even though the chaos is subdued, I'm seeing more opportunities today than I've seen in the last several years, because the realities of the market are now catching up to people. The increased interest payments are catching up to people. People have to make a move. They want to sell. They want to get on with their lives, whatever the case may be. The point is, there's some great deals out there, and I'll tell a few stories about that. But what do you think investors, Patrick, should be doing given these rate hike announcements? Because people are really attached to, what am I going to do about the rate hike? But there's some opportunities out there.
Listen,
I'm listening.
At the end of the day, we know that the cost of borrowing is higher. We also know that getting mortgages is more challenging and more difficult. But this goes back to things that we've been talking about for many months, probably even over the year, which is the creative buying strategies. We know that the demand is starting to get soft, which is really saying that there are motivated vendors out there. There's people that have to get from underneath. So there's motivated vendors, which means that there's opportunities for creative buying strategies, number one. Number two, I think not all markets are markets to jump in. We've said time and time again that real estate is regional, so you have to know the market that you're in. The deals that you were able to take advantage of is because you know that market like the back of your hand. So when you see these deals, you can make a decision, you can move forward, you can put that offer in, and you can get those deals. You can take advantage of it. So is every place the place to buy? No. But we've always said that it's very regional. The one thing we do know, and this consistently, we've been talking about this, I don't know, for 3 years. At the end of the day, we know that the rental demand is going to continue to increase because affordability is being pulled away from those individuals who want to buy a house but simply can't. And many who would want to buy a house are going, no, I'm going to rent because I can't qualify, number one. Number two, I don't have the down payment. And most importantly, number three, many people still think that there is going to be an absolute pop of the real estate market. And then the next thing you know, real estate prices are going to plummet. So a lot of fear, a lot of confusion, a lot of uncertainty is driving rents. We know rents are continuing to come up in many regions. And so there's still opportunities for investors who are going in and paying attention to the deals, doing their cash flow, doing their analysis into markets that they know and are doing the research on.
My number one piece of kind of feedback for investors right now, Patrick, whether they're just starting out or experienced investors, is they really have to focus on their timeline. They have got to get clear on their timeline to see, are they investing for the next 5 years? Are they investing for the next 10 years? Are they investing for the next 20, 30, 40 years? Because I'm telling you right now, this is presenting us with incredible moments in time where you can pick up stuff at a great price. I'll talk about price in a second. And yes, you're going to have to pay more interest to have the opportunity to buy it at that great price. But that's exactly what this is. These high interest rate environments have presented people with an opportunity to buy real estate at a great price. And I'll share some stories on that. But all of that gets washed out when you look at your timeline. If you forecast out, Patrick, and I want to ask you a question, because you're the seasoned guy on the block. I didn't call you old. I'm just saying you're seasoned. But you've bought property, and I want you to think back in your memory banks right now. I know I'm putting you on the spot, but Think back in your memory banks and tell me a property that you bought that you thought you were overpaying for. Just think about it right now. And you thought, oh my gosh, I can't believe I'm spending X number of dollars, probably like $226,000 on this property that you overpaid for. You don't have to stretch out that picture very long that it becomes very irrelevant how much you paid for that property, even though in the moment you thought you paid a lot. I had lunch with an investor yesterday who was buying properties in Oshawa and Whitby and Ajax, and he was buying semi-detached for $225,000. And he thought to himself, he thought he was crazy. He thought, I don't even know if I'm ever going to make money on these things. Those properties are selling for 800,000 today. And that's the point, is that was only 7-8 years ago. When you look at timeline, it washes out these details. Give me an example in your case, Patrick.
Well, I don't, I couldn't come to a specific example. All I know is I always thought I overpaid for real estate. But, when we come down and at the end of it, I look at my real estate portfolio, and I've sold very little of the portfolio per se that, my core portfolio. The point is all of that is irrelevant to your point, which is, over time heals all of those, what we think are wounds at the time, because it's like you're in the market in the moment. Certainly had a couple of opportunities where I bought those deals and went, no, that's a good deal. But in some sense of it, there's a lot of real estate that I bought over the years that I always felt like I overpaid for. That's just the psychology of things. But I want to point a couple things out. When we look at what's happening in this country, when we look at the immigration that's coming in, when we look at the job market that continues to be strong, although we got to talk about that a little bit. We know that the fundamentals remain very strong in Canada. So GDP, immigration continues. Is GDP softening? Yes, and we could argue and talk about that. But the point of all of this is, JG, is that interest rates are an influencer. So when we start to create a thesis going forward about where do we see interest rates in 2 or 3 years, do we see them at these kind of rates in 2 or 3 years? I don't. I mean, anything is possible. And certainly, that's why I want to fire Tiff Macklem. But at the end of the day, we look at interest rates, and to maintain this level of interest rates I don't think will be economically feasible. They're going to have to back off. Now, I'm not suggesting for a moment that they're going back to those ultra low rates, but I think, they're going to have, over the next couple of years, I think we're going to see interest rates come off. And so, you have to look at the future state of that as an influencer.
Well, let's consider that. Let's play out that scenario, Patrick. I just had a deal recently that I purchased, and it's been a fantastic deal. I bought it for $150,000 under list price. 150,000 under list price. You tell me a time when you could buy properties at 150 grand under list price, and you'll be, it's hard to name a time recently where you had those kinds of opportunities. Now, you can buy it at $150,000 on the under list price. By the way, this property was available on the MLS. This wasn't a pocket listing. Anybody could have bought this. Nothing special about it. Needs lots of work, needs lots of renovation. We got a great plan. I'll tell you what doors opened up on this. Number one, when you buy it that much under list price and under market value, okay, it may not have been worth what they listed it for, but it's still worth much more than what I paid for it. So I bought it under market value. But what it does when you buy a property under market value, is it opens up exit options. And if you look at this property that I'm talking about here, I'm going to be able to, my plan is to do a flip on it. Now, right now, is it the best time to flip? No, it's not the best economic time to flip, because we're not in a boom cycle. And as you're heading into a boom cycle is the best time to flip. But when you buy it at such under market, under value, it opens up those options of, you can flip it, you can convert it into a duplex, or you can convert it into a triplex because of the new Bill 23 in Ontario, or you can convert it into a student rental, or you can assign it. There's all these different exit options, which last year, Patrick, you didn't have these exit options. You bought a property at a much higher rate. You had a better interest rate, but you bought it at a much higher price. And price and interest are obviously have gone in different directions right now. The point I'm making is there's no better time, if you have the right timeline, to say could be a great entry point into real estate, because what I paid for this property in 3 years from now, or even if it's 5 years from now, when interest rates come back down, all I'm going to look like is an absolute genius, because I bought it at the right price. Interest rates are going to go up and go down over the course of the over the course of this career of mine, same as your career, same in everyone's career. But what is fixed in time is what you buy that property at. That's in stone after you buy it. That's your entry price. Then it just becomes, what are you going to do with the property? So, long-winded way of saying, Patrick, that I haven't seen deals like this in the market for many, many, many years, and it's opening up a ton of options. But here's the kicker: investors have to be educated, and they have to have the right tools, specifically the tech tools. Man, there's some incredible tools we're working with that we can touch on later, Patrick, but there's some incredible tools out there, tech tools, to help you identify these opportunities so you can be ahead of the game. And I think that right now it's a golden hour for that.
Well, I think there's a couple things that we need to kind of unpack, and that's those statements that you made. Number one, there's deals that are out there, but they're not in every market. The conversation you're having, for example, in Peterborough is different than a conversation that they're having in Toronto, which is different than a conversation they're having in Vancouver, or a conversation they're having in Calgary right now. So that's not to say there isn't deals out there. And the one thing that we do need to shine a light on is using the technology to find those deals. There is definitely new technology. We're introducing new technology that's going to support people in finding those particular deals right across the country. The conversation is more regional than it's ever been. During that boom cycle, all boats were rising on a high tide. I mean, how many times did we use that phrase? It's not that way anymore. Tides are coming in into ports at different paces and with different strengths. So the point of it all is that we have to look at those regional markets to know that there are deals out there. And let's face it, it goes back to, the other metaphor that we've used before. When you're looking for gold, diamonds, silver, whatever it might be, you just don't walk down the street and pick it up. You got to dig for it. You got to blow stuff up. You got to look, you got to work. And there is a lot of work to be done, but those deals live there. That gold, those diamonds, they live in the real estate world when you dig and you look for them.
I agree, Patrick, 100%. And I think something you said is bang on, which is real estate is regional, more regional than ever before. But there are deals in every single market. I don't care what market you're in, whether you should or shouldn't be investing in that market. That's a decision you need to make as a sophisticated investor. But in every single market, there are deals. You just got to go digging for them.
You got to dig for them.
That's all about the rate hike. That's all about what investors should be doing about the rate hike, depending on their timeline. Focus on your timeline, ladies and gentlemen. Stop getting caught up in the headlines. Focus on your timeline.
If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
If you want to see more stuff like this, click here. If you want to see the entire show, click there.